Hello, friends. I hope that all are fine and enjoying their lives. Well, basically, life is all about keeping yourself motivated, keeping yourself energized, and keep on working hard towards achieving your aspirations. Well, we from our YouTube channel are thinking to bring a IFRS refresher session series for you guys. We are starting from IS2 inventories, and weekly we will be uploading videos regarding IFRS, and we will cover all the international financial reporting standards in our videos. You all are requested to subscribe to our channel, listen to our lectures. In case any of you have any questions, want to discuss anything, want to discuss about the practical application of the concepts that we discuss here, you are most welcome. So we are looking forward to have energized participation from you guys in this IFRS refresher course that our YouTube channel is bringing for you guys. So let's start from our today's lecture, that is IAS 2 inventories. So basically, the objective, scope, and fundamental principles. The objective of IAS 2 is basically to prescribe the method for accounting treatment for inventories. What is the scope of this standard? Well, basically, IS2 covers items which are held for sale in the ordinary course of the business, which means, for example, if it is a manufacturing concern, the items which the entity has produced for selling to the market, for example, pharmaceutical product, the pharmaceutical products it manufactures. Any other like packaging company, the packaging product it has manufactured for sale in the ordinary course of business. Items which are held for sale but not in the ordinary course of business does not come under this standard. For example, if any fixed assets are held for sale, then they will be covered under IFRS 5. So assets which are in production process, which will be converted into inventories, which will later on be sold as ordinary course of the business, also comes under this standard. Material which is consumed in production of goods to be sold in ordinary course of business also comes under the scope of this standard. What does not comes under IS2 is it does not covers work in process. For construction contracts, there is a separate standard for that. Financial instruments, we all know that there is a separate financial reporting standard for that. And biological assets, there is a separate standard for that, IS 40. The fundamental principle of this standard is that inventories, items which are held by business for sale as an ordinary course of the business. Ordinary course of business means that the sole purpose, the scope, or the rationale for which the entity is registered itself, and those items which the entity aims to sell to generate the required revenue, the need that the entity is there to serve. So inventory should be measured at cost, and the fundamental principle is that inventory should be measured at lower of cost or net realizable value. We will discuss that how the cost is calculated and how net realizable value is calculated in our upcoming slide. Well, cost. Cost of inventory covers cost of purchase, cost of conversion, other costs incurred in bringing the inventory to the present location and condition required for sale of the item in the ordinary course of business, borrowing cost if it meets the definition of qualifying asset IS 23. Does not include abnormal waste. It does not include the storage cost, the warehousing cost, admin overheads which are not related to the production of that item, selling cost, and foreign exchange differences, recent acquisition invoiced in foreign currency. So foreign exchange differences do not become a part of the cost of the inventory. Method. If the item of inventory is not interchangeable, then the specific cost incurred in making the item ready for sale. And if the item is interchangeable, then first in, first out and weighted average method. Last in first out method was previously allowed by the standard, but now it has been disallowed. While inventory should be measured at the end of the reporting period at lower of cost and net realizable value. Net realizable value, how to calculate it? Net realizable value is basically the sale proceed expected from the sale of the item minus the cost to sell the item. So if any given date the cost is higher than the net realizable value, then we have to write down the item to its net realizable value. Now let's move to the last slide. Expense, when the item will basically be sold out, it will be measured in the profit and loss statement as cost of goods sold. Or if the inventory item is written down to net realizable value, then also the disclosures required by the standard are the accounting policy for measurement and reporting, for example first in first out or weighted average cost. Then the carrying amount, lower of cost, and net realizable value, amount of write down of inventory during the period, and cost of goods sold. These are the disclosures required by IS2 from the entities. So I hope that we have covered IS2 in sufficient detail. We will be covering next IFRS in our next video, which we will make for you guys in the next week. So stay tuned, stay connected. Please subscribe our channel so that whenever we upload new video, you guys automatically get a notification alert. And we hope that this IFRS refresher session will be helpful for you guys. And if you have any practical application questions, do discuss with us, and I will be more than happy to help. Thank you.